All right. Another Monday night, another live Q&A. I'm excited to get into it. Anything you guys want to talk about. Joey Garassi, thanks for being here bright and early. Telling everyone to smash the like button. We can talk about whatever you want to talk about. And generally, I'll start off with a couple minutes of random thoughts. Once we get 7, 8, 10, 15 people joining, you fire questions at me. And then by 10 or 15 minutes in, we've got 25, 30 people supplying enough questions where it can just be a Q&A for 90 minutes straight, answering any and all questions. I love to hear them because it's a representation of questions that people are having across the country, right? A couple things to note, just things that are on my mind. People always ask, what's happening in the mortgage world? If you guys want to talk about your boy, Vishal Garg from better.com, I'd be happy to. And anybody who knows me knows that I'm an eternal optimist. I like to see the best in people. But I knew from the start, when this company started, that this dude was a bad apple, right? In previous business dealings, I read about this at least a year or two ago. The dude threatened to burn an ex-partner alive. I don't think it's a very nice person that says things like that. Has been known to kind of rule with an iron fist and just be a bad leader, a bad boss in general. So the latest news around our boy Vishal comes from people sharing a Zoom call he did last week, where in all of 3 minutes, he told people, hey, listen, it's the holidays. This is hard to do, but you're fired. 900 of them. And if you watch it, it's not that long of a clip. He said, I've had to do this one other time in my career, and last time I did it, I cried. And he showed little to no emotion, where it was about as what's the word? Disingenuous. About as disingenuous as they get. Like, the guy is just not a good dude. We're getting a good comment from my buddy Kyle over at Win the House You Love. Operating at a loss to gain a bunch of market share, and then when it's gained enough market share where you can get 750 million in funding, then you're like, all right, shed all these people, and so just bad look on his behalf. The fact that he got 750 million in funding, there was no reason why I had to fire these people all at once, like they were running out of cash and couldn't meet payroll or something. The guy's worth $4 billion too. So you contrast this guy and his actions and how he runs a business versus my friends at UWM and Matt Ishbia, who runs United Wholesale Mortgage, who's a personal friend. I've sat on his advisory council, has told employees repeatedly, and I know he means it, he will sleep on somebody's couch before he lays off a single person. He just doesn't do it, right? And so it's a stark contrast between a leader and a value system that trickles down throughout a company. And maybe this guy's got really good people working for him, but like when you're type of leader like he is, my guess is that he's got other leaders around him that are also not the kindest folks, right? All kinds of stuff around this that we could talk about. Tens of millions of dollars was kind of funneled off to one of his executives over this last year. So they're getting stock incentives that are worth 10 million, 20 million, 30 million. But then like, hey, the market's changed. We've got to fire 900 people. I don't know. And he's come out and said, like recently, like I hope to grow better real estate 10 to 100 times, telling workers to expect stricter deadlines and more attentive management than before. If you felt in the past that people weren't looking, well, everyone's looking now. He's telling people like, we're monitoring you. If you miss a call, if you're not working until your eyes bleed, you're out of here. That's not a way to operate a business. I'm pretty sure through talking with, employees of United Wholesale Mortgage, the contrast one that we're talking about, they've implemented 4-day work weeks. They've implemented like a buffer where if you got to get your kids to school, you can come in up to 30 minutes after your start time. All kinds of stuff like that. That is like the exact opposite of leaner, meaner, hungrier, like this guy's talking about. So enough about him. Let's move on. Jump into some questions. And one other thing, market related, that I feel like I got to talk about, because it's something that when I feel it and see it in my business, I know that it's something that perhaps other people are seeing or feeling. I am proud of the agents I work with and some of the things that I'm seeing out in the market, sellers. And I don't know if necessarily the agents or the sellers or a combination of the two are getting greedy, and some of them are paying for that greed. And I'll give you a few examples. Had one over the weekend where a seller got an extraordinary offer, countered with the most ridiculous terms I've ever seen. And the buy agent, who was on the buy side, told me, hey, Matt, I know you like to reach out to the list side and you like to, let them know that we're strong, we can close on time and all that stuff. Don't bother responding to this. It offended me and my buyer. And this is not someone we want to work with. We're not going to, abide by some crazy, strict, fast timeline, extra cash, extra, verbiage about the appraisal. Like, this is just too much. No thanks. Move on, offer on the next property. Then I get one today where a client of mine offers a good offer on a house that's been on the market for 25 days. They offer 1.2 million. Maybe if this place has been on the market for a month and it's listed at 128, you can't get it for 1.2, but maybe you can get it for 1,250, 1,225. The seller's countered at 1.3, which again, buy side, buy agent said, you know what? No thanks. Moved on and now offering on a new property. I think that some of this, I don't know if greed's the right word, but crazy expectations is probably a good word for it. I don't know how long this is going to last. Sellers have been in a position of extreme amount of leverage that they have. They've been in a really good position. If they ever start to get in a position that's not as good as they are in now, some of these tactics, some of this stuff that's going on where you counter ridiculous terms and somebody agrees to it, it's going to stop being acceptable. It's going to stop being accepted. Because like I told a couple agents I work with, the bad part is in a market this competitive with this much demand and this little inventory, somebody's going to give into these crazy demands. Somebody is going to actually say, all right, this is wild what they want to write in. This is wild, contingencies, and this is wild price, but I want the house. So fine. I'm not rooting against anybody except for that I wouldn't be sad if some of these sellers got handed some humble pie. Where they turned down or countered or tried to, get more than they should, and buyers walk and they sit for 2 months or don't sell at all. I think that might happen. Maybe not immediately, but sometime in the near future. Just my 2 cents. Thanks for being here, Joey. I appreciate it. Yeah, let's get the like button popping so YouTube knows what's going on over here. And I don't know what they do with that like button. They let people know that we got some good combo going on. Good evening to Mr. Kevin Hawthorne and No Co Don. How you guys doing? Liberty returns. What's the pros and cons of borrowing from a private lender? They quoted me at 3.25% and $4,800 closing cost, and I can put at least 20% down. I guess private lender, some of the pros are that you might not have to go through the whole loan process, which is underwriting and appraisal, and the private lender can make whatever rules they want. So if their rules are less strict or easier than, let's say, a conventional loan, maybe that's a pro, right? The con, if I had to think of cons, it might not report to the credit agency if it's a private lender. So maybe, you don't get the credit benefit of having that mortgage on your credit, but that could also be a pro, right? If you're able to get 10 conventional loans and, these private loans are loans with a private investor that don't show up, maybe that's a better deal. $4,800 closing costs. If that's including title fees and appraisal and other stuff, then that's probably decent. If that's just like what they're charging you, then it might be a little bit steep. So maybe that's a con. I don't know. I think that there's definitely both sides of the coin, and depending on your goals and whatnot, it might be something that fits for you and your investing strategy and your goals, and it might not. All right, first live you've been able to do since your wedding. Congratulations on the wedding. I'm sorry that Home Possible did not sponsor the wedding, but if they knew how much you're a believer and a supporter of their program, they might just do it. At least send you some Home Possible swag, right? Congrats on the wedding. Heartless, yeah, talking about better.com. And it's funny because I had somebody this weekend that was talking to me, and we were talking about the terms on a loan and purchasing something with 15% down. And apparently better.com was 1/8 better on rate than the lender that I was going to broker the deal to. And I told the person, I said, listen, I know for a fact that my deal at this rate with no lender costs at all is really good pricing. And I know for certain things aren't going to change. I know for certain we're going to get the loan closed within the escrow period. I know for certain the client experience is going to be a great one. You go with them for 1/8 of 1% on rate. Who knows what happens? I've heard horror stories and had people that went to better.com take 45, 50 days to close, horrible customer service, horrible experience. And they just laid off 900 people. So I don't think they're getting any better, right? So with all that being said, yeah, heartless, and hopefully they pay for it. I'd like to see the market, whatever the opposite of reward is, punish that behavior. Man, it must be late. I can't even think of the reward, punish, opposite. All right, who else we got? Yep, karma. BQuez saying what's up to me and Kyle. If you guys don't know who Kyle is, Win the House You Love, the best mortgage YouTube channel out there. The guy's got like some pretty cool stuff when it comes to mortgage education and calculators and spreadsheets, and just great dude. He's focusing a lot of time and attention on serving consumers at a high level. So I gotta tip my hat to my buddy, Win the House You Love. Oh yeah, thanks, man. If anybody missed it, the cool part is, Joey, is I think it's been 3 years in a row when there's been new loan limits announced. I've had one or both of my boys on those videos. I'd have to go back to 2021 and 2020 loan limits being announced, but I had like a Facebook flashback of doing the loan limits with one of my kiddos from last year. And it's got to be at least the third year, maybe 4 years of loan limit videos with the kiddos. And then that last one that came out, I had to bribe my 8-year-old and tell him he was going to get the ad revenue from it. So it's made $8 or $6.93. He's pretty stoked to make $7. He's going to buy some Roblox. Okay, loose Lucerne. Oh man, this is, oh, I'm sorry to hear. And the bad news is the loan will not go through. They'll do a verification of employment towards the end when they're drawing docs. And if there's, HR or employer letting the lender know, oh yeah, this employee of ours was furloughed, no longer going to be able to use that income for this loan. So if you qualify without that income, you can still close on the loan. But if you need that income to qualify, it's not going to make it. I had one, it was either early 2021 or late 2020, where the client of mine said, hey, Matt, I got to be honest with you. And I think this was one where signed final loan documents and said, hey, somewhere in those loan documents, it said that like I attest to the fact that I'm working this job or still employed. He said, they just let us know that my job's ending the end of the month. I'm going to get a severance package. Didn't feel comfortable. And I said, I agree with you 100%. Like, I don't want anything fraudulent on my record. You don't want to do that. And so what we did is we canceled that loan. As soon as he got a new job, we were able to resubmit it and get the loan closed. So in your case, if you need her income, I think the best bet is to hopefully she can find full-time, full pay, salary type job that you can use right away, even within, immediately with getting a job offer letter. But that might be your only option if her income is needed on the loan. Sorry to hear that. Hopefully it works out for you. Fifi, hello, back at you. Basilio, does FHA cash out refi have a better interest rate than a regular conventional cash out refi? Yes. But here's the thing. If you have an FHA cash out refinance that's at 2.5%, and you've got conventional cash out refinance that's at 3.25%, on the surface, wow, FHA is so much better, 2.5% versus 3.25 on a 30-year conventional. And I'm just throwing random numbers out there. Know that like your credit score, your loan to value, property type, all that stuff's going to play into what your exact interest rate is, whether or not you're paying points, all that good stuff. The issue with FHA is that it could be worth $800,000 and you're doing a $300,000 loan. No matter what the loan to value is, you're paying mortgage insurance. So that 0.8% in mortgage insurance is going to give you a blended rate that's higher than conventional. It might be close. It might be like a tie between interest rate plus mortgage insurance on FHA versus just interest rate on conventional. And in that case, if there's a tie, you want to go conventional. You don't want to have mortgage insurance that sticks on that loan forever. In the case of a refinance with all that equity, it might fall off after 11 years, but still you don't want that mortgage insurance on there for 11 years. Oh, I see. If you got a ton of equity in it, I'm planning to move to one of my rentals next year. I'm trying to see if it makes sense to wait until I move. Well, if you do a cash out refinance now, while it's a rental property, it'll be rental property rates, probably high threes, versus if you move into it and do a cash out, you're going to get primary residence rates, low threes. So take FHA out of the equation and just look at investment property rates versus primary rates. Other thing to consider is like, what if you did it now and you got a 3.625 on a cash out investment property? And then 6 months from now, you're moved in, the primary rate might be 3.625. You just never know. The primary rate's always going to be 0.5% better, but we don't know what today's rate versus 6 months from now's rate is going to be. Something to consider. All right, Joey Garassi. Garassi? I think it's Garassi. I feel like I'm saying it wrong. You'll correct me. You'll tell me the right way, and then I'll forget it before the next Monday. So bear with me, my man. Calculating PMI for conventional loans. Great question. It's going to depend on how many factors. Credit score. I'm writing it down so I don't forget. Loan to value. Is that it? You get the discount for Home Ready, Home Possible. You know that. I think that's all that goes into it. Loan to value and credit score. For instance, you've got a 700 credit score and you're putting 5% down. You've got mortgage insurance that's based on 700 and 5% down. You've got a 760 score and you're putting 10% down. You've got 760 score and 10% down mortgage insurance rate. The more down, the lower the mortgage insurance rate. The higher the credit score, the better mortgage insurance rate. If you're putting 3% down and you have a 680 score, mortgage insurance might be astronomical. It might be 1.5 points. $300,000 loan, it might be $400 a month. But, conversely, man, I'm using big words tonight. If you've got great credit and 5 or 10% down, mortgage insurance could be almost non-existent. I'm doing a loan right now where it's a $600,000 plus loan. And the person is putting 15% down. They don't have enough to put 20, but they're putting 15% down. Huge loan amount. Less than $50 a month in mortgage insurance. And it's because great credit score, 15% down. If they're putting 10% down, it'd be a little bit more. They're putting 5% down, a little bit more than that. 3%, even more. And then as it goes down in buckets for credit score, it gets more expensive as well. So it's so much cheaper than it was 2 years ago, 3 years ago, 5 years ago, where 5% down in great credit, the mortgage insurance is really cheap. And then more down, even cheaper. So it's constantly changing, and it's cheap. All right, Sarah Lynn. We are currently under contract closing the 31st of January. Any recommended VA lender with good rate and less fees? By VA, do you mean Veterans Affairs or do you mean Virginia? Either one, I can help you. If you're talking about VA loan as in a veteran, talk to a good local mortgage broker. You would be shocked at the difference between some of the banks, some of the direct lenders, and then a mortgage broker. We might be 0.5% better on a rate. When it comes to FHA and when it comes to conventional, there's not that much of a disparity between lenders. There's still a disparity, but when you get into government loans, some of these lenders, not naming names, have humongous margins where I'm like, where in the world is this person getting a 3.125 VA rate when we can offer them 2.5 or whatever it is? Talk to a good mortgage broker. I know one by chance, and I know how to get a hold of them. It's really easy. You go to greatmortgagebroker.com. You fill out a quick form, where you're buying, what you're looking to do, and we'll set you up, me and my team. And if it's in Virginia, it's the same answer. Greatmortgagebroker.com, set you up with our Virginia folks, and they will hook you up. I don't know if you're still on here, but that's the best advice for either one of those. Virginia or loan for a veteran. All right, No-Co Dawn. Refinancing my single family that I own free and clear. The lender got me a loan for 4.125 and 3.75 points. Oh my God, those 3.75 points. Not happy at all. I wouldn't be either. Those terms are wild. Unless you have a 640 credit score and it's for like a $82,000 loan, these terms are bonkers. Bonkers. I mean, the good news is if you're not happy at all, you don't have to proceed. But that's wild. Construction to permanent loans, I don't. I've, over the years, as we've gotten busier and busier, I've kind of prided myself in doing the stuff we're really good at, and the other stuff, referring it out to somebody who does that stuff all day, every day. Here locally, I've got a great contact at Umpqua Bank. They do great construction loans and have a construction to permanent program, which I refer to them, and I'm happy about it. If me and my team try to take on construction to permanent and down payment assistance and all kinds of other stuff, we would, not be able to handle as much and serve as many people as we do. We'd be spread too thin. So that stuff and bridge loans and all kinds of stuff are going to be referred to people that do them all day, every day. Is it true that I need to live 12 months in the house before I can do a FHA cash out refi? No. I mean, there's no minimum time lived in the house. Again, you gotta kind of figure out whether you want to do FHA cash out, because it's not always going to make sense paying that PMI. When you've got enough equity to do cash out, paying MI is sometimes not the right answer. Definitely need, since both of us are on the loan. Unfortunately, can't use unemployment benefits because those are something that have a limited term to them. So it might be a case where you got to get at least the new job offer letter. And we can use income as long as it's salaried up to 60 days before the job starts. So even if your wife went out and got a job that said, we're hiring you starting on February 1st, 2022, your pay is going to be $54.26 per month, salaried, be able to use that, but not unemployment benefits, unfortunately. Current loan, $185K, current property value, $305 to $315. Yeah, I mean, you can look at a 75% or an 80% cash out refinance conventional, Basilio. I don't know if it would depend on your credit score on looking at FHA and conventional side by side. But just like so many things in mortgage, here's the best piece of advice. Whether it's me and my team, whether it's any other mortgage person you're talking to, I'm looking at pulling cash out. I'd like to get $50,000 in cash out to do this or do that. It's worth $315. 80% loan to value loan is going to be $252. So that's going to be probably $60 once you got fees rolled in there. $60,000 in cash out, and then if you went 75% LTV, $236. Maybe that's $45,000 cash out. So 45 or 60. You can look at 45,000 cash out at 75% loan to value. You can look at 60,000 cash out, 80% loan to value. Conventional and FHA. Put them side by side. If you've got a 760 credit score, conventional is going to blow it out of the water. If you've got a 640 credit score, FHA is probably going to make more sense than the conventional. But the only way to truly see it is base it on your specific scenario, your credit score, your wants, needs, goals, everything, and then put them side by side. And then have a mortgage broker who's honest and going to talk you through, hey, listen, based on what you've told me, you want about $45,000 in cash to go do this project or that one. Don't go up to 80% loan to value because it's more expensive. You can do 75% loan to value and be able to get that cash you're looking for. And based on your credit score in this, look at conventional versus FHA. Conventional looks better because of X, Y, and Z, whatever the case may be, right? That's the conversation that you're going to have. It's going to help you make a more informed decision. Refinancing into a bad loan or an expensive loan or something that just isn't right for you at the time can cost you a lot of money, right? And something you can't undo. 2 years from now, you look back, you're like, oh shit, why did I do FHA? The other thing to think about is the 1.75 upfront mortgage insurance premium. You do a loan at $315, they're going to bake in, I'm surprised I didn't think about this earlier. They're going to bake in $5,512 upfront mortgage insurance. Just stick it on there. Add it to your principal balance. Just for doing business with the Federal Housing Administration. So it's got to be a real clear-cut winner to go FHA in order to choose FHA. All right, Johnny Stash. Putting offer and waiving loan contingency. Our employment is stable, not doing big purchases. Credit and DTI is excellent. Should I worry about loan getting denied after going into contract? Okay, if you've got a good loan professional you're working with, you and your wife both have W-2 income, have been at your jobs for a good length of time, it's as straightforward as can be. Like salary, $88,000 a year. She's salary, $62,000 per year. And there's no funny stuff at all. Good credit, nothing could pop up there. Then I wouldn't worry about it. You say DTI is excellent, so maybe your DTI is 18 over 26. I've told plenty of people this loan would never get denied. There's nothing in here to deny. Then I'd be okay. But for me to say it as a broker, kind of put my reputation on the line, and I know that I'm putting somebody out if for whatever reason they can't get a loan to the finish line, then you'll be good. Okay, C. I'm writing this down in my notes. I think I said Jurasi or something one time, right? Jurasi. I got it, bro. Jurasi. This is a great question, Papa Heather, and I appreciate you bringing it up because this is going to be the question of 2022. People have a ton of equity. People want to pull cash out for a number of different reasons, investing in other appreciating assets, paying off debt, putting down in a vacation home, whatever the case may be. People are going to want to pull out cash in 2022. They're going to have this exact problem. I've got a 2.5% on my first. Should I pull the equity out of my home or should I go get a home equity line of credit? I've made videos in the past where I said, listen, don't go refinance and increase the rate on all this debt to pull $50,000 because now you're paying 3.25% on 450. When you had 400 of it at 2.5 and you're pulling 50 more out and now you're paying 3.25 on all the 450, that's not a good idea. I mean, 0.75% on that 400 going from 2.5 to 3.25 is an extra $3,000 per year in interest. You don't want to do that. I mean, even if you got the $50,000 HELOC at 5%, you'd be better off. Have a strategic plan to pay off that 50 as soon as possible. Partly because most of them are adjustable rate. So I might go 5, 6, 7%. If it's closer, if you're 299 and the loan amount is less on your first, say you only owe 100 and you're pulling out 80. Sorry, my neck itches today. I don't know what it is. It's going to itch it. There's no shame. Right. So if you owe 100 and you're pulling out 80 and it's going 299 to 32, maybe that's not that big of a deal. When you got a big first, 400, 500 at 2.5, leave that mofo alone. That's my personal opinion. Because it's expensive to pay more interest on all of it. Oh, 8:30 reminder to smash the like button. You're 2 hours ahead of me. Where are you at again? Joey Juresi? I nailed it that time. Probably in Tennessee. All right, Victor. Is there any possibility to refinance a second mortgage that is delinquent? My parents have 2 mortgages in their house with the primary mortgage in good standing, but the second mortgage delinquent. I do not believe so. I would contact that company directly. Back, in the real estate crash in the 2007, 8, 9 times, I know there were seconds that were settling. Right now, where people have tons of equity, I would think that a mortgage company in second position is going to be less likely to settle, right? Maybe they owe $42,000 and you're delinquent in a couple months. You're like, hey, listen, I'm having trouble. I might just have to let this house go. Can you settle? We'll give you $22,000. Pay this thing in full. In 2009, they're probably like, send us $22,000. We'll call it even. We don't want to gamble with you. That you might not pay us back any of it, right? But nowadays, where everybody's got equity and the thing's probably worth more than you owe between the first and second, I don't think they're going to negotiate a settlement. And I don't know anybody who wants to take on refinancing that thing, which basically means they're taking over the debt and paying off this current second lien holder. Refinancing in general, when you have any type of mortgage rates at all, is hard. So my honest answer is I don't think there's anything that can be done here besides get it current and get it paid off as soon as possible. All right, house appraised for 180, got a 102K loan, rolling my 8 properties into a portfolio non-QM loan. So this 3.75 points, is it just on $4,125? Is that a non-QM loan? If it's a non-QM loan, not that bad. I was thinking conventional. If that's a 65% non-QM, 4 and 8, 3.75 points, not terrible. But that small of a loan amount, I would almost ask them like, can I pay 2 less points and take a 4.625? Or can I pay a point less and take a 4.375? I'd take a higher rate and pay less points up front because you only owe 100, right? You can throw some extra money at that and get it paid off and save some interest without paying that big old fat up front to lower the rate on such a small loan amount. That's my 2 cents. Tina it's either Tina Inca or Tina in, like an in California. Kyle Seagraves, Win the House You Love. That was the YouTube channel I mentioned earlier. Way better than this YouTube channel. But stay tuned in for this, and then wait until we're done until you log into his. Win the house you love. That's my guy. I accidentally clicked on that, but that's who you're looking for. He does great stuff. So check him out. But after this is over. All right, Theo B, another familiar face. Thanks for joining again. When buying a property and appraises for 20 to 30 more than the purchase price, can you immediately do a cash out refinance, pull out that equity? Purchase price 285, appraised 325. Here's the problem. No, you can't immediately. Whenever you do a refinance, if it's within 6 months of you buying that specific property, you have to use. Let me back up. This is a common investor burr dilemma. You buy a house for 200, you invest 40 into it, it's now worth 3. You're trying to do a cash out refinance to get out 225, and we can't do a loan for above 200 because that's what you paid for it if you're 4 months out. Like your max loan amount, if you try to refinance within 6 months, is the purchase price. If you bought it and then tried to refinance 3 months later, I don't think it's going to appraise for 325. Again, maybe it does. It's a great question. I think you got to wait 6 months. If you bought a house for 285, no matter what it appraised for, and then you went to refinance it 3 weeks later, an appraiser is going to come out. They're going to look at comps. They're going to go, oh, here's a great comp. This house sold for 285. I'll use that as a comp. And they're going to appraise it at 285 or 290 is my guess. Maybe I'm wrong. God, that's a good one. That's a really good one. You might have stumped me, Theo. Because like what would... Oh, it's genuinely got all these other comps and it's worth, 325, 330. All right, I'm stumped. 325K, 285K. I'm going to try to talk to somebody in an underwriting department that might know the answer to this question. All right, I'm noting it down. And I'm going to respond, I promise you. All right. Joey Juresi. Do you think the wintertime is probably the best season? Though it's still a tough market, I heard there's generally less competition and some sellers might be more motivated to sell. Generally, the winter is a better time to buy. Right now, it is friggin' bonkers, dude. At least where I'm at. There's little inventory and there's a ton of buyer demand. A ton. We're getting crazy counters. The one I told you about earlier where we offered 1.2 and they countered at 1.3. And there's buyers out there that are willing and able. So winter in general, probably. Winter of 2021, early 2022, maybe not. It is tough right now. BOJ, I am. How soon can I cash out refi after loan modification? Loan amount 110K. House worth 700. We'd have to run it by underwriting. Every modification is different and how it shows up on credit and how they're reporting your loan mod, how they're reporting the mortgage payments leading up to it. I'd want to submit the deal. And that's what I would tell you if you're a client of ours. If you went to greatmortgagebroker.com and connected with us, let's package it up and submit the file. See what underwriting says. With a refinance, if we're unsure at all, we submit the loan, see what they say. We don't have to order the appraisal, so you're not out any money. We're going to get an answer. All good in the hood, or the appraisal and roll. No bueno, we ask why. But that's probably your best bet and what I would do if I was in your shoes. Mo, is going with the builder lender usually the worst? No, not necessarily. I've been as straightforward as possible with any client who's come across my desk that says, listen, I'm working with X builder. They connect me with their lender. They said I got to get pre-approved with them. Show me what they're offering. Let's put it side by side with what we're offering. I've seen it where they offer a $2,500 incentive and our loan is $6,000 better. We've got thinner margins and we're just offering a better loan. Our $6,000 better outweighs your $2,500 credit. I've seen other times where their lender pricing is in line and we're exactly the same in pricing. And they get a $5,000 credit if they use the builder's lender, and they get nothing if they use us. I've had builders penalize a borrower for using an outside lender. And in that case, they cornered you. You almost got to use them, right? Unless you want to pay $5,000 more because you like my style. And trust me, we got people that are like, we want to work with you. This builder's lender is terrible to work with. And even if it's slightly more expensive, we're fine with that. But yeah, you just have to find a broker you like and trust that's going to give you honest feedback. I've probably been 50-50. We've got some right now in December. The builders are offering a crazy incentive to close before the end of the year because they're trying to get the stuff off their books. And they're offering I've seen 5-figure builder incentives. Use their lender, get $12,500. That's an end of year special right there. That's like buying a car on the 30th of the month. They're trying to hit their numbers. Go buy a house. Tell them you can close by December 31st. Might get a deal. Yes. If you leave the home equity line of credit open, they're going to count it towards your DTI, the full rip, right? If you close the home equity line, then you're good. But from a lender's perspective, it's like you have access to it. So we could close our loan. You could immediately go pull that 300. And if you did that, we want to know what our debt to income would be, what the risk would be. So a lot of times too, you might owe $450 on your first mortgage, have a $300,000 home equity line of credit and $1 million value. Our combined loan to value is 75% because it's 450 plus 300. We're not going to allow you to do a cash out refinance up to 700 with that $300,000 HELOC, because that'd be a combined loan to value of 100. So they're going to, one, count it into the LTV, in the CLTV, combined loan to value, and two, factor in the payment and factor into your DTI because it is available to you, and you could literally pull it anytime. No code on. Should I keep one property in my name just for credit mix or do a complete portfolio loan? I mean, if I was you and you've got great credit, I wouldn't think that it would really hurt, your credit to have no mortgages, right? You just have like installment loans and revolving debt, no mortgage debt. So I'd probably put it all in a portfolio loan. I wouldn't leave one just for that sole purpose of having a good credit mix. But if you're concerned about credit and credit score and you want to, make sure you keep it good and you're at 707 right now, you want to, then maybe. But other than that, I think I'd put it all in a portfolio loan. Just makes it easier and cleaner in your head and accounting wise and all that stuff, in my opinion. Same advice if you own free and clear, refi or HELOC. I guess it's a little bit different, right? Because earlier I was like, don't mess up that 2.5% first you got by refinancing into a higher rate. Here where I think it's what you want to consider, refinance versus HELOC, if you're free and clear, is how much do you need and how soon are you going to pay it off? If you only need $50,000 and you plan to pay it off in 3 years, it's HELOC all day, every day. If you want $250,000 and you want to spread it out over 20 or 30 years, 15, 20, 30, then you do a cash out refinance. The pros of the cash out refinance are that it's a fixed rate. It's available over 30 years. So the payments are small. And, HELOC, it's going to be cheaper. It's going to be the pros for the HELOC is in general, there's less fees associated with them, but you might have an adjustable rate and, it could be amortized over 30 years and you might be paying interest only. So that the payments might be low, but you're just going to be at the mercy of the interest rate varying and whatnot. So those are things I would consider. NorCal, what's up? I'm in Sacramento. Where are you at? Joey's in Oklahoma. I knew that. You told me that once. I forgot. My bad. Just like I forgot how to pronounce Juresi. Woo-hoo! You got something to worry about, Maria. Sorry. I hate to be the bearer of bad news, but I got to keep it honest as can be on this channel. And your conditional loan approval came back. Once they do 4506T or whatever they do for tax transcripts and they see that you owe back taxes, well, hold on. I take it back. If you are already in a payment plan, that's fine. We can show the terms of the payment plan, add it to your debt to income ratio, and you're cool. If you owe back taxes, you haven't entered a payment plan, you just owe them, then the lender is going to want you to, 1, set up a payment plan, or 2, pay it off in full. So you're going to have to do one of those things. And depending on the loan type, it might be set up a payment plan and make 1 payment. Might be set up a payment plan and make 3 payments. Pretty sure conventional went back to just 1 payment. Just have to have it set up and 1 payment made. I'm fairly certain on that one. It's been a while since I've been in the nitty-gritty trenches of knowing all the mortgage guidelines, but methinks that's what it was. So yeah, I would probably proactively bring that to your loan officer's attention. What should I do? Because you don't want to ignore it and have it come up at the 11th hour when they are drawing docs and they're like, oh, hey, by the way, your tax transcript done told us that you owe them a few dollars. That would be no bueno. Is the max loan amount the purchase price, or I thought it was the LTV to purchase price, i.e. 70% of purchase price? No, you're thinking when I was talking about the like for the BRRRR stuff. For the BRRRR stuff, if you bought for $200, put $40K in rehab, and now appraised for $300, even though it appraised for $300, and you should be able to go cash out to 75% on an investment property, you wouldn't be able to go to $225 because you'd be capped at that $200 you bought it for, if you're within the first 6 months. If you did this same deal, BRRRR, bought for $200, put $40 into it, it appraises for 300 6 months later, you're good to go. Cash out to 225. Let's pause for a commercial break. I'm going to do, this is a YouTube selfie. I'm doing a day in the life for my marketing team. They want to see a day in the life. So let's do a YouTube selfie. Day in the life. All right. There we go. You'll see that show up in an Instagram story tomorrow. A look behind the scenes of a day in the life. Matt the Mortgage Guy. It's a fun life. When we do B or RRs, we're told that we must wait 6 months to close it, or it'll be based off the purchase price, regardless of how high the appraisal is. Sounds correct. I think, yeah, maybe you're referencing the one we talked about earlier where it's like, hey, if it appraises for higher, can I do a cash out refinance right away? And I was going to check on that for Theo. And I don't think we can get a higher appraised value within 6 months, but that might be only FHA. All right. Now I've got too much mortgage stuff going on in my brain. Let's just do like Fifi. Let's just smash the like button. I don't have it pulled up on the side like I usually do, so I don't know how many likes we got. Somebody tell me. Oh, Zeta just got in. It's all right, Zeta. I accept your apology for coming in late. For you, I'm going to stay on for another 20 minutes. I can't go too long tonight because I got to get home to the family, do a nice home-cooked meal. But thanks for joining. Tina's in Chico. Close to me. Chico's a cool town. All right, James, let's check out your HELOC question. A lot of people have HELOC questions. 2022 is going to be the year of cash out refinance and HELOC. I can tell you that it'll be very important for anybody who's in the position to take equity out of their home to have people giving them good advice around which one is a better fit and a better decision financially, right? Because you make the wrong choice, it could be detrimental to your finances. These are big decisions, right? People are taking out $300,000 loans. People are taking out six-figure home equity lines of credit. One versus the other could make a difference in, future plans, net worth, all that other stuff. So talk to smart people. It's my best advice. Okay. I'm using 75,000 of the 300K HELOC. So I think what you mean is lenders don't see 75K. They see 300. Exactly. Yeah. They actually look at like what's available and take that into account. Like you had asked, I understood exactly what you're asking. And that's the thing is, they're looking at available credit. And so sometimes you got to close those things down to get a loan done. Zeta, I don't know. It might be. This is something that's really interesting. I went out to lunch with a buddy of mine who's a commercial lender on Friday. We talked about the credit markets tightening in 2022. Might be the case. And there might be HELOCs that are harder to get. And there are times in history, and there could be times in the future, where you could have a home equity line of credit like James, and they might just send him a letter and say, hey, your $300,000 home equity line of credit, we just lowered it to $100,000. Thanks for your continued business. We appreciate you as a client. That stuff happens, right? Credit tightens for whatever reason. I think big banks have shown it in the past where they'll just shut down lines completely. And so it could certainly get harder, Zeta. And not only does it get harder for people trying to apply for a new home equity line, but the people that have existing ones can have those shrunk or closed. All right, Maria. On back taxes, they didn't see it once they did the conditions for my conditional approval. They did ask for payoff of my state taxes, which I have paid already. The fact that it was not seen does not mean that you're out of the woods. Things come up on all types of reports run in the background from lenders, from underwriters, where you're not safe until you're safe. Docs get drawn. You can sign documents. And before it funds, they go, oh, we just found this on the Cavers report we ran. Oh, we just found this on a repull of credit. Oh, we just found this on, the tax transcripts that were run in the background. I would be proactive about it and talk to your loan officer. Loan officer's on your team, right? On your side. If they say no transcripts needed on this deal, no way that it's going to come up, no issue here, maybe you're all right. I'd probably err on the side of caution and want to figure out what would need to be done to make sure that lender's okay with this outstanding debt, which usually means you've entered into a payment plan, made a payment on that payment plan, and that payment fits in your DTI and doesn't affect you qualifying. It's my 2 cents. You are very welcome for the advice. That's what we're here for. Give advice. I don't have all the answers. Theo stumped me earlier. Didn't have that answer, but I'll get it. We'll be back next week to answer that one. No problem. Thanks for the question, James. No worries. So helpful you smashed the like button. I appreciate it. Keep the questions coming. I probably got another 15 in me at least. We can talk about the housing market, what's going on with mortgage rates next year. Hint, they're going up. What's going on with inflation, how inflation is going to affect interest rates. Well, not a lot of news today on the Fed, right? We're always watching the Fed. What's the Fed doing? What's the Fed talking about? Last week it was like, hey, listen, we might have to hike rates faster, sooner. We might have to speed up our tapering of mortgage-backed securities. All this stuff was like, rates are going to move up faster. And then I think it was Omicron, the newest variant, that was like uncertainty in the markets, bad news, and Omicron was helping rates more than the Fed was hurting rates, right? So if Omicron starts to fade, and now we've just got the Fed talking about tapering and cranking up interest rates in 2022, then rates will finally start to move up as so many have predicted. But like we saw with Omicron, nothing is certain. We can't know what we don't know before we know it. So, how soon do you think mortgage rates will go up next year? I think they will go up steadily over the next 6 months. And what we've pretty much seen the last 3 months will continue, where it's up, down, up, down, up, down. But the trend over time is up. Let me see if I could pull up. I'll pull up a chart and I'll show you. I'll show you what I see. Let's go 6 months. All right, share screen. This one. This is the last 6 months. Let me see what's this peak right here. Probably, if I were to guess. Yep. Man, that was around my birthday. August. I remember the week after my birthday being ugly for rates. These red candlesticks, this is rates getting worse. So if you take like early August, this is like August 3rd, 4th in here. My birthday is August 4th. If anyone wants to send me a birthday present. You know, a lot of up, down in the interim. But over time, the trend is down, right? On a 30-year fix, maybe this is 2.625. And then maybe today it's 3.125. You know, so it's 0.5%, but it doesn't all happen from one day to the next. It goes up to 2.75, and then it gets a little bit better, and it's 2.67. Then it's, you know, back and forth between 2.75 and 2.65, and then boom, 2.875. Oh, it gets a little bit better. It's 2.82. Worse, 2.875, 3%, 3.25, 3.375. Oh my gosh, rates are disgusting. Everyone's like 3.375 is the worst I've ever seen in my whole life. I can't believe it. People from the 80s are like, this is ridiculous that anybody could complain about anything sub 5%. Then, better. Oh my gosh, we're sub 3% again. Ha! Very short-lived. What day was this? November 10th. That was an ugly day. Worse, you know. Now we're kicking around between 3%, 3.25 on the most perfect of scenarios, right? Anyhow, that was fun. Trending down like that into next year, where by the middle of next year we're 3.625-ish. 3.75-ish. That's my best guess for what mortgage rates are doing. Do I offer a pre-approval letter so you can get a construction loan in Colorado? Do you need the pre-approval letter for the construction loan? Sounds like that, maybe. GreatMortgageBroker.com. That's where you go for all the best advice, for connecting with my team. No matter what state you're in, GreatMortgageBroker.com. That's where you want to start. I hope that we have got more inventory in 2022 as well, Zeta. I am on your team right now. Part of the reason, like very early in this live, I talked about sellers being greedy, sellers being unrealistic, sellers doing some crazy things. Not all of them, but some of them. Partly is because they can, because there's nothing on the market. I had a buyer miss out on a deal where the realtor, when I called, like, oh, they didn't get it, sucks. The realtor told me, no, Matt, that was too much. I'm glad they didn't get that one accepted. I was like, all right, cool. Respect that. That as an agent, you care about the buyer, care about them overpaying, and that's more important than your commission check. That's a good real estate agent. But it's happening. He was telling me it's happening because there's so few things out there that some of these flaming piles of poop are getting bid up because there's a lot of demand and not enough inventory. All right, Tina, I got you on basis points. So when people talk about basis points, when they're talking about interest rates, one basis, okay. I'm going to use an example. Let's say you talk to a lender and the lender says, I can give you a 3.25% with no points. Or I can give you a 3% and it cost you 1 point. 1 point equals 1% of the loan amount. So let's use an example. In our example, I said 3.25 was no points. 3% cost you 1 point. If it's a $400,000 loan, 1 point is $4,000. So the lender's saying it cost you $4,000 to get the 3%. 1 point is equal to 100 basis points. So if the 3.125 is 50 basis points, 50 basis points is half a point. On this $400,000 loan, that's $2,000. So if you looked at a rate sheet and it was like this scenario I'm discussing, if I was Win the House You Love, I would be able to write this on a whiteboard that's connected and we'd be able to screen share it. It would be amazing, but I'm not that good, not yet. 3.25, 0. 3.125, 50 basis points, which is $2,000. 3%, 100 basis points, otherwise known as 1 point, $4,000. So 1 basis point, Tina, is 1/100th of a point. And a point is 1% of the loan amount. $400,000 loan amount, 1 point is $4,000. Every basis point is $40. And so some people might say, it's 27 basis points to get this rate. It's 60 basis points for this. You can look at 60 basis points and just say 0.6 points. 0.6 of, one being 1%. So 0.6% of loan amount. Hopefully that makes sense. Did I? Yeah. Okay. The basis point. Yeah. Basis point is 1/100th of a point. Original lender offering 0 fees on cash out. Take $50K cash out at 3.25 or HELOC. It depends on how fast you can pay off the HELOC. I think I'd probably lean towards HELOC. I wouldn't want to mess with that 2.5%. I'd take 50 in a HELOC and have a plan to pay it off in 3 years. You get to keep that 180 at 2.5%. That's pretty sweet. I don't know though. I mean, there's a case to be made. If you can take that $50,000 and get 14% returns, then it's like, so what? You're paying 3.25 for your $230,000 loan. That's kind of an aggressive stance to have, but some people think like that. And so maybe, that's something you consider, right? Even if the math is just, or the instinct is like, no, I don't want to take a higher interest rate. Maybe it makes sense in the overall scheme of things. All right, no con, Don. You need it for a construction loan. GreatMortgageBroker.com. Check us out. All right, last couple questions. That's bedtime. If you buy a home with an FHA or VA loan, how soon can you purchase another home with same loan type? Well, with both of these loans, they have to be your primary residence. And if you sell and then want to buy forward with that same loan type, you're good. If you're trying to keep those loans in place, then FHA I'll do first. I've got a video called 2 FHA loans or something to that effect. They have exceptions for holding 2 FHA loans at once. You move 100 miles away for a job relocation. You can get another FHA loan and keep that original FHA loan. You're all good. You buy the FHA loan with a co-borrower. The co-borrower stays and you leave. New FHA loan. Okay. You've got an increase in family size. New FHA loan. Okay. So In those scenarios, you can do it a year later, year and a half later, no big deal. But there has to be a reason, an exception. And just like any other loan, if you buy a primary and then try to buy another one 4 months later, even if you have that exception, underwriter's not buying that stuff. Usually, right? Some people have to relocate in a short period of time and it makes sense, but not always, right? And then VA loan, you can have more than one VA loan. You have to, one, have enough entitlement to qualify. And talk to any lender that does VA loans. They'll be able to run those numbers for how much VA entitlement you have. And this happens all the time. You buy a place in Texas, you relocate to Beale Air Force Base. Now you're out in California. And we've got to figure out if you got enough entitlement to keep that loan and buy the new one out here. So hopefully that answers your question. If you did it very soon, because the question talks about how soon, then they're going to ask you questions about why so quick. And you better have a good reason. It better not be because I'm trying to build a portfolio and I'm moving to a new house every 3 months, or not moving and trying to commit occupancy fraud. You got to explain yourself. If you take a HELOC and you can't trace it to investment property, it's no longer deductible on your primary residence. So factor that in. Good point, Dina. Talk about the tax implications is another factor, right? Cash out refinance versus home equity line of credit. If interest is deductible on your taxes, but with a HELOC, you're not able to trace the use of those funds and deduct it on your taxes, then that's something to factor in. I appreciate that comment because it's something that I knew but forgot to mention. Are there things mortgage brokers don't want to see in a real estate contract? I've heard writing termite report can cause trouble because now there has to be a clearance. For sure. We don't want to hear about termite. We don't want to hear about repairs. We don't want to hear about property conveying, horses in the stable and things like that. And it's not like we're trying to be shady or go around stuff. It's just everything you put in the contract, the underwriter is going to see and ask questions on. And what I've seen is that there might be something that's a really simple fix, but you put it in a contract, like a termite report goes in here, and any termite report, any sort of home inspection, any sort of repairs, that kind of stuff is going to be looked at by an underwriter, and they say, oh, it looks like you referenced the home inspection and the roof. Now we want a roof cert. Oh, it looks like you mentioned the home inspection and this part of it. Now we want this inspection or proof of this or that. It's just going to cause more questions and more red tape to get the thing through underwriting. So keep that in mind. As always, appreciate the heck out of every single person that joined here. Every Monday night, 6 p.m. Pacific Standard Time. We're keeping it that way. I thought I was going to have to reschedule it because my kiddos' basketball practice was originally going to be Monday nights. They decided on another night, so I'm stoked we can keep it consistent. Mondays, 6 p.m. Pacific Standard Time. If anybody has feedback on the time, I would love to hear. I can't believe that people are on the East Coast. This thing starts at 9 o'clock for them, and they're tuning in from 9 to 10:30. If the same folks that have been consistently joining think that another time makes more sense, please, I'll probably do another poll on my channel to find out, because I just want to do it at whatever time makes sense to everybody. We get the most questions, because the more questions that come in, the more answers I can give. And the people that are tuning in either live or on replay are going to get their questions answered. They're going to make better decisions about their personal finances, about their mortgage. And that's what we're trying to do, is spread mortgage education across the interwebs so more people can win in real estate and make good financial decisions around their mortgage. And with that, thank you very much. And until next time, we gonna see.